Yes, we are live. So we will continue the discussions from where we left off yesterday. So let me just share my screen. Yes. Okay. Yes. So we were discussing the five conditions yesterday, and we are reasonably through with condition one and condition. Okay, condition one. There were five conditions which I told you are very important for identification of contracts because these indicators should be there. Otherwise, the contract is not binding or the contract is not a satisfactory one as per the definition or the clarification provided in IFRS 15. What are the things that should be included in the contract? One should be it should be accepted by both parties and there should be an undertaking or a commitment to fulfill the contract by both parties, like seller will sell the goods and buyer will pay the remuneration as promised. Number two is the contract should have an commercial substance. The rights and responsibility of both parties are well mentioned. Then the payment terms are well mentioned, and also there is an expectation that the goods and services will be delivered, and of course the payment would be received. There is a probable chance. It's not that there is no indicator to kind of confirm that the payment will not come. So all these conditions should be there in number one. And only when all these are cumulatively satisfied is when you can say that you have identified a contract for the purpose of IFRS 15. And we also checked on performance obligations. Okay. The whole thing, what is a performance obligation? It is a promise. Okay. Promise by one party to deliver goods and services as agreed in the contract to another party. Now, for performance obligation to be recognized as such should be distinct. Distinct meaning it should be identifiable and separable from whatever else is there. So if there should be a distinction when it comes to performance obligations. We also discussed that distinction is identified by few parameters. One is does anyone recall? Hmm? You remember these lines? The customer can benefit from the goods or services either on its own or together with other resources that are readily available to the customer. Okay, they can enjoy the goods and services on their own. That particular distinct goods and services on their own, in either on its own or in combination with resources that are readily available. And also the entity's promise to transfer the goods is separately identifiable in the contract. These, paras 22, 27, 29 we discussed yesterday. Now let's move on. And we did this question also, right? Of the solutions, we identified that these four are four distinct performance obligations. Okay. Now let's move forward and let's go to condition number three. Now, with respect to condition number three, we have to determine the transaction price, right? Now, where would you recognize the transaction price? Can somebody send me in the chats? From where do you identify the transaction price? Yes, from the contract, absolutely. The transaction price would absolutely be there in the contract. And if you remember, we discussed that the payment terms are one of the key conditions for identification of contract. The point one with respect to revenue recognition. So obviously, the transaction price would be available in the contract. Then why do we need an explanation as to determination of transfer price, determination of transaction price? That's because transaction price can take various forms. Let's take an example. Okay. See what kind of forms it can take. It can take something called fixed consideration. That is, if A sells to B a particular amount of goods, B will pay a, let's say, dollar 1,000. That's it. How determination of transaction price here is very easy, right? It is a fixed contribution. If you fulfill this performance obligation, you will get this amount, this fixed consideration. Things will get a little bit before we move forward, one thing, you can see my Excel sheet, right? You can see my screen. Can somebody confirm the chat?
Yes, sir.
Oh, so there is fixed consideration. Second thing is variable consideration. So what is variable consideration? Let's say that A is selling B a good at, let's say, they are selling a product worth 40 dirhams per unit. Okay. A sells to B. Now, A is, let's say, a manufacturer and B is a dealer, okay, or a wholesaler or a distributor. That's the way you can call it. Now, normally, if you go to the market, it's 40 per unit. But A tells B that if you manage to sell almost 1 lakh or 100,000 units in 6 months, then you can buy it from me at $25. Okay. So whatever I sold it to you, I would just take a revenue of 25. If you sell lesser than 100,000 units, you have to pay a per unit purchase price of 40. If you sell more than, if you purchase more than 100,000 units, then you pay me only 25. Is such agreements really plausible? It's very plausible in the market. Is it easy? Is it happening or not happening? Yes. Does these contracts happen in the market or not? Manufacturer will set up limit and say that if you purchase more than these much units from me, then I would reduce the purchase price. I'll give you a volume discount. Such things happen. Conditional volume discount. Can you confirm to me in the chat? Yes or no? Yes, absolutely. So when things become like this, when it is a variable consideration, how do you account? So that is what is one, and also there is one more financing arrangement, but we'll look at variable consideration first. In case of such kind of a arrangement, what would be the revenue that would be recorded by A? Now let's put in some more numbers here. Okay, so there are 6 months, right? So okay, so let's say that in the first month, B purchases around 500 units from A. What would be the revenue that you would consider? Whether it is 500 units into 40, which is a normal price, or 500 into 25, 12,500. What is the revenue that we will recognize after sale of this good in month one? At this point of time, we don't know if he would purchase 100,000 units or not. Okay, but the offer still stands. And the first month, I have only he only purchased 500 units. So what would be the revenue that I would be recording? Says 20,000. Okay, okay. Now see, in such scenarios, what we do is we have to, at the time of recording the revenue, that is at the end of month one, when this sale is completed, we have to check if there is a high probability that, we can record at this value or this value. Okay, we can record at both values, provided you have to make an accounting estimate. The estimate is that it is highly probable that the revenue so recorded in that period will not considerably change, will not change at all. There is no need of a revenue restatement. That means even though he has purchased only 500 units, but I expect him to purchase 100,000 after month 6. Then even though I sold 500, I can account the revenue at 12,500. But if I don't feel that he will buy, then here what they say is you should record revenue at this price only if it is highly probable that whatever you recorded will not be restated, the revenue will not be restated in the future. So unless you have that surety, you cannot record at 25, you have to record at 40. Okay, are you understanding this? Yes. Okay, now if you have understood it, let's go read the. Okay, now the transaction price is the amount of consideration a company expects to be entitled to from the customer in exchange of transferring goods. So the transaction price would reflect company's probability weighted estimate of variable consideration, including reasonable estimates of contingent amounts, in addition to the effects of customers' credit risk and time value of money. So they are explaining that there are variable consideration, the customer's credit risk adjustment as well as time value of money, which has to be considered while looking at transaction. Variable contingent amounts are only included when it is highly probable that there will not be a reversal of revenue when any uncertainty associated with the variable consideration is resolved. Okay. Examples of where a variable consideration can arise include discounts, rebates, refunds, price concessions, credits, and penalties. This is what we discussed, right? And how to account it? Variable contingent amounts are only included when it is highly probable that there will not be a reversal of any revenue. In determining the transaction price, the entity must adjust the consideration for effects of time value of money in the timing period. This is something else. Now, how will end of the day the accounting look like? So let's say that let's complete this chart and how it looks like. Okay, so let's say that he's buying 500. Okay, he's buying 25,000 units. I'll just remove units so that I can talk it. Yeah, he's buying 35,000, 15,000, and 10,000 and 5,000. Okay, so the total units he purchased is only 95. Okay, let's make this 15,000 and this 10,000. Okay, so let's say that this is the total he purchased, right? Now, in deciding the revenue for month one, at this point of time, we have to analyze whether he would buy 10,000, 100,000 or not. Now, if you look at the hit rate or any law, if such a question comes in the exam, also you have to look at the hit rate. He has only bought 500 in month one. So if he continues this trend for 6 months, what will happen? He will only buy 3,000 units. So he will not purchase more than 100,000 units. So you have to record revenue at the original price of 40. Okay. Now he buys 25,000. What is the cumulative revenue? We'll add a cumulative unit. What is the cumulative unit? Okay. So once we get the cumulative unit, we see that 25,500 is in month two. Now we have to calculate. So 25,500 he purchased in 2 months, right? 25 plus 500 into 6 divided by 2. It is still not more than 100,000. So we will still record the revenue for this 25,000 units sold into 40. Okay. Now let's take here 60,500 is the cumulative value, and he purchased that in 3 months. So into 6 divided by 3, if I take 10, it is going above, it is reaching 121,000. So now I will record the revenue in 25 because now I have a improved certainty as to this. You can choose to record here or you can choose not to record here. It's up to you. You can record only when when they cross the 100,000 threshold also. Okay, but if you want to record it 25 here, then it's well and good. Or we can go at 40 even. Let's for the matter. So even okay, the cumulative frequency is more, but I don't think he will purchase more. Here also he is only 75,500. So I will record it 40. Here he is 90,500. So 15,000 into 40 again. Here in the sixth month, it is 100% sure for us. Now he has exceeded 100,000 in year six. I mean, sorry, month six. So we will record this revenue in 25. And what we will do is, now what we will do is we will have to reverse. So this would be the revenue which we, this was based on fixed contribution or the contingent element. Variable contingent element was not taken while calculating for this. It was only taken here because we are 100% sure. Now we have to restate these values also. Okay. So we have to restate. We have to remove this revenue of we have to remove this revenue of revenue finally considered. This restatement will happen in year six and it would be are you getting it? Now, what would be the accounting entry that you would be using for such transaction? So, in year month 1 to 5, when we are selling, if we are selling, we would use the entry as bank to revenue, and we will be recording it 40 per year, correct? So that we recorded is how much? 3.6 million. Okay. This is what we recorded from month 1 to month 5, right? Now in month 6, however, we will record a revenue of, and they will be the same. We'll be recording a revenue of how much? We'll be recording 375,000, correct? Right? Now in month 6, we also have to reverse the revenue because we told them that if you paid more than, if you purchase more than 100,000, all the units you bought would be at 25, not at 40. Now in month 6, there is also a reversal entry. because we are paying him back. Bank is credited. And what would be the amount? It would be the amount of this. Okay. This amount which we restated. This is not to be restated because this is already taken at 25 only. So how much we are restating? 1357.5. This we will be restating the revenue in month 6. Okay. So, so you might have a doubt that why we are restating, even though we took it at certainty. See, because he increased the value. So contingent consideration should only be looked at when it is certain. Otherwise, we will go with our normal consideration itself. We will not take the variable consideration. When there is a variable element, we take the variable element only when it is sure that a significant reversal will not happen as a matter of taking the variable consideration. Okay. So now it is clear to us, and now we are reversing the entry. You can choose to do it here, or if your estimates are right, you can choose to do it here as well. Because once we sold 75,500 units, if you take the estimate or year 3 as well, right? Not year 3, year 4. Are you getting this example and the entries posted? Yes or no? Okay, perfect. So with that understanding, let's do one question. Okay. Now let's do this together. Taplop supplies laptop computers to large businesses. Okay. On 1st July 2025, Taplop entered into a contract with Trilco. Okay. Taplop is the seller, Trilco is the buyer. Under which Trilco was to purchase laptops at $500 per unit. The contract states that if Trilco purchases more than 500 laptops in a year, okay, the price per unit is reduced retrospectively to $450 per unit. Tapslop's year end is 30th. Okay. So on 1st July is the contract. And so we have to see if he has purchased more than 500 laptops in 31st June 20x6. Okay. Now they are given some breakup data also. At 30th September, that is the year is starting from July, right? So 30th September means 3 months. July, August, September. September bought 70 laptops. Taplop therefore estimated that Trilco's asset would not exceed 500 in the year 30th June 20X, and Trilco would therefore not be entitled to volume discount. Okay, at that time they expected their probability, their estimate was that they will not exceed the limit of 500. During the quarter ended 31st December. So we are running past 3 more months. Okay, at the end of 6 months, from the start of the year, Trilco expanded rapidly as a result of substantial acquisition and purchased additional 250 labs. Okay, they already purchased 70. Now, within this 3 months, they purchased another 250. Now, the total purchase is now 320 laptops. Taplop then estimated that Trilco's purchase would exceed the threshold for volume discount in year to 30th June. Calculate the revenue Taplop would recognize in quarter ended 30th September and 31st December. We need to apply the principles of IFRS in revenue from contract with customers. See, this is how a question will come. And I think we are reasonably prepared to do this. Okay. Can we do it together? Okay. We'll name this Taplop. So what is that you have to write? So they're asking for two things. Calculate the revenue Taplop would recognize in. So we are measuring the revenue. Okay. So first thing you have to write, then first we will write as of September 2000 expert. Okay. At 30th September, how much laptops were purchased? 70 laptops. And we did not expect it to exceed 500. Correct? So what price would I account it at? So normal price is 500, discounted price is 450. What price would I account it at on 30th September 25 for the 70 laptops purchased? Hmm? We will be doing it at 500, absolutely. So, so we just have to calculate the amount. So as of September, we have to write that we have to first identify it as this is how you have to write, identify it as a variable consideration. And since it is a variable consideration, we have to quote the IFRS 15. What it says, it is highly probable that recording the variable consideration will not result in a significant reversal or a reversal of revenue. Correct? And in then we will come to 30th September. In 30th September case, it Taplop, the seller, is not sure, right? Is not sure whether they would be purchasing. So what they would have to do, they would have to record it. 70 laptops which are sold at into $500 sorry. Correct? Now, as on 31st December 25, they bought 250 more laptops. Correct? And by that time, estimated that would exceed the volumes. So it is now highly probable. So we will record the 250 laptops into $250 into $450, sorry, at the reduced price. Okay. Now we have to do one more thing in 31st December. Can somebody tell me what? Is it all? Is it all when it comes to principles? Is there something else that we should do? Nothing. Okay. See, these laptops are we have had a line here that it is retrospectively applicable. Correct? It would be reduced retrospectively to 450%. Right? Now this we had accounted at 500 because we were not probable there. So on 31st December, we will do one more thing. That is for 70 laptops, we will be recording it at reverse so that excess revenue which is counted will be getting adjusted. Okay. Adjust excess revenue, which is accounted in 30th September 2025. Reversal, yes. Okay, now let's look at the solution, how they're writing. This is how you should write. Applying the requirements of IFRS 15 to real cost purchasing pattern, the Taplop should conclude it highly probable that a significant reversal in the cumulative amount of revenue would not occur when the uncertainty was resolved. That is when the total amount of purchases were known. Consequently, Taplop would recognize 70 into 500 for the first quarter. In the quarter ended, Rico's purchasing pattern changed that such it would be legitimate for Taplop to conclude that Rico's purchases would exceed. Therefore, it is appropriate to reduce price to 450. To recognize the revenue of 109,000. Okay, for the quarter ended, the amount is calculated from 112,500. Okay, plus the change in transaction price of 3,500 for the reduction of laptop 400. So instead of re-recording this and then reducing, what they did is this minus this is the final This is the revenue that is recorded in 31st December 28. Okay. Are you getting variable consideration? Are you clear? Any doubts? Yes or no to variable consideration? Yes. Okay. Just take it into consideration when it is highly probable that there won't be any significant reversal. Okay. Now let's consider significant financing component also. Now what it means is that let's say that A is purchasing, okay, a goods from B. Okay, A is buyer, B is seller. Now what is happening is the goods, let's say, are performance obligations are satisfied at a point of time. That means once the goods are sold by B to A, the performance obligations are satisfied. And let's say this performance obligation was satisfied in 1/20 expired. Okay. But the payment from A to B, as per the contract itself, the payment is only due by 31/12/20 XA, right? So you give me the product now, I will pay you after 4 years, right? So these things could happen, especially if you are purchasing heavy machinery. Okay, the person who's selling heavy machinery would be having it as their inventory. It could be their revenue. It could be their ordinary course of business. Now, if you sell it to these small scale industries and all, the government itself would intervene and say that the payment period is 4 years. So you will get your money only after 4 years once they use your machine and the business is built up for some, is able to kind of reap your money. So these things are very common. So what IFRS says is if you sell, hmm, and if you're going to get money only after 4 years, then let's say that if you're selling the price of the asset is 121 times. Okay, this is what you're selling, and you will get that after 4 years. Okay, and the standalone price in the contract price is 121,000. The standalone price is, let's say, 100,000. Obviously, the seller would sell to A at a premium, right? Because I'm getting my payment only after 4 years. So if you would have seen this. If you give ready cash, I will pay you it. I will can get it at 100,000. But if you are paying only after 4 years, like EMI stuff and all, then you pay 121,000. So the standard says even the price of the goods, the contract price is 121,000. Ideally, recording the whole 121,000 as revenue is wrong because this has two elements. 100,000 being the standalone product, which is your actual revenue, and the remaining 21,000 is actually interest. Okay, finance income, and that should not be recorded as revenue. It is finance income. If you sell now, you will get only 100,000. No, you are getting 121,000 only because you are getting the money after 4 years. So that compensation, that additional compensation over and above the standalone price is nothing but a, a consideration for taking interest in the nature of interest, and hence it has to be recorded as a finance. So whenever you are looking at a revenue transaction, even in your accounts, even with your clients, if you see that the payment terms are more than 1 year, then definitely there is a financing component involved. Okay, so you have to use time value of money and discount it to present value to find the actual amount of revenue. Okay, is that clear? Yes or no? You have to segregate from the revenue the financing element. the financing element should only be recorded as finance income, not as revenue. Are you getting it? Hello? Okay. Okay. Now let's read the notes. Okay, let's do this. Okay, on 31st December 2007, Landsale sold product X to a customer for 12,100, payable 24 months after delivery. The customer obtained control of the product at contract inception. The cash selling price of the product X is 10,000, which see standalone price is 10,000. The contract price is 12,100 because it is payable 24 months afterwards, which represents the amount that the customer will pay upon delivery of the product. Okay. The cost of the product to land scale is 8,000. That means it's their, 8,000 worth of product they're selling at 10,000. This is their margin. But here 8,000 worth of product is sold at 12,100 because they are getting it only after 24 months. Right. Now, in this situation, prima facie, looking at the question, how should the accounting be? So, as of 31st December 20x7, when the performance obligations were satisfied, that is, I sold the product, what is the revenue that I should recognize? Yes. How will the accounting come here? What is the revenue that I need to show in 31st December 20x7 when I sold the product to customer? Yes. What should be the revenue that I should show? So yes, you're right. You should show only 10,000. Okay. Now, how will you show this 2,100? Let's look at the entry part of the whole. Okay. Now, how will the entries come in this scenario? Okay. So 31st December 2007, I sold the product, right? So revenue, yeah. So I'm not getting anything. So it is AR, right? I'm getting it only after 12 months, 24 months. So AR account debit to revenue, right? How much would you be accounting? 10,000. Okay. Now, same in 31st. Don't you also has to show cost of goods sold? Because if you're showing revenue, then you should also account for cost of goods sold, right? So what would be the entry for cost of goods sold and what would be the value? That's why they have given the cost of the product as when we go to the presentation, we will see that you should always show revenue and cost of goods sold. So that's why they have given this particular piece of information that does not fit in the significant financing component. Okay. So let's do the entry for cost of goods sold. What would be the entry cost of goods sold to inventory? It would be 8, right? Now, I am getting this after 24 months, correct? So this 2,100, which is the difference between 10,000 and 12,100, can we assume that that is 2 years interest, right? We can assume that it is 2 years interest, right? So the first year interest is payable after the expiry of first year. So that would be 2,000 x 8. We would be receiving, AR account debit to finance. And how much is that? 2,100 divided by, right? 1,050. I will recognize. And same in 2000 x 9, I would recognize and interest income, right? And finally, what would be the total? Let's say that what would be the total balance in AR account now? It would be 10,000 that we recognized at the time of sale and 1,050 over 2 years. See, we are matching that interest income to the particular period, hence 2 entries. And this 12,100, it is due by 31st December 29. Once he pays, we would be getting 12. So this would be the entries that you have to do when there is a financing component. Okay, where it is not just enough that you split the financing component. Okay, that is what normal people do. If you understand these standards and the matching concept and the conceptual framework well, you would split the finance income into two and also get this Cox entry. Because since they have already mentioned such a thing, we should definitely give Cox entry. It kind of affirms with the examiner that you really understand how the accounting framework works. Are you getting it? How you should record? Any questions on this entries that I made? Any question? Okay, that's pretty good. So let's move on. So let's see the entry. First year, um, to record revenue at a related receivable of 10,000. Sale of interest income on the receivable should then be recognized in years 31 X8 and X9 at effective interest rate based on the contract term of 24 months in accordance with IFRS 9. This would be presented in the operating category of statement of terms. Okay. Now, allocation, allocate the transaction price to performance obligation. So that these are the two things which you have to mention, which you have to be wary about when you look at variable consideration. The two things are, when it comes to identifying the transaction price, one is if you identify a variable component, then only account it if there is reasonable probability or there is high probability that there won't be any reversal due to recording in the contingent consideration. And also the second thing is you have to see if there is any significant financing component in the transaction price or the contract price that is quoted. Okay. Now we have done three steps. That is identification of contract, performance obligation, bracket make distinction, and three, identifying the transaction price. Now the fourth step is allocating the transaction price to performance obligation. Okay, now how do we do that? It's pretty simple in a prima facie contract. No? If you just have to allocate. Hmm? Now let's take some example we had yesterday. Let's do this. You remember this example? You remember this example, right? It is a proposal that we had, and the proposal includes, services pertaining to incorporation, finding common space, renewals, accounting, audit, etc. For 1 year, we are charging $50,000. Okay. Yes. Now you tell me, how do we have identified the performance obligations. Yesterday we had a whole debate about it and we understood that since the services can be consumed, by itself or with respect to services that are readily available to the customer, it could be, this or everything could be a distinct performance obligation. So there are how many? 8 performance obligations in one contract price. Now you tell me, how do I allocate this to the contract? How do I allocate this contract price to these performance obligations? What does the IFRS say? Okay, this is where the game. This situation is very plausible. Like, I mean, 8 performance obligations in one contract. But how do I reasonably allocate it to everything? So for that, the IFRS says that you have to find a standalone price. What is standalone price? Standalone price is price of these items separately, right? If I am only taking company incorporation service, what would be the cost? You have to find the standalone. So let's say that the standalone price is 10,000 each. For ease of simplicity, or let's say that this is 20,000. This is 2,000. This is 5,000. This is 3,000. Okay, let's say this is the total. Now, what is the total? 70,000. 70,000 is the total of standalone services, and the bundled one, since he is taking everything together, we are giving it at 50%. So what they have saying that you have to allocate the contract price in the ratio of the standalone price. So you have to find the ratio of standalone price. Okay, it would be this divided. So you have to find what is the ratio of the total standalone price for each person. So a company incorporation is 10,000 and the total of all the standalone price is 70. So this is the ratio. Okay. So now in this ratio, we will divide 50,000. So the transaction price that would be allocated to each of them would be in the ratio of their total of standalone price. So in what ratio would we do? We wrote dollar 50,000. That's why it was not correct. Now it will, right? This this is how the standard tells us to allocate a bundled transaction price into performance obligations when there are too many performance obligations and one altogether bundled price for each. You have to find the standalone price of each, understand the ratio of standalone prices to the total of their standalone. What is the ratio when you take the standalone totals? And based on this ratio, you have to divide your transaction price among separate performance obligations. That is the highest level of complexity that could come from allocating performance obligations to allocating transaction price to performance obligations. Is this clear? Yes or no? Okay. So we will read this. When a contract contains more than one distinct performance obligation, a company allocates the transaction price to all separate performance obligations in a proportion to the standalone selling price of the goods or service underlying each performance obligation. If the goods or service is not sold separately, the company would have to estimate its standalone selling. So if entity sells a bundle of goods, it also supplies one bundle, the separate performance obligations in the contract should be priced in the same proportion as the unbundled prices. Okay, that's what we did. This would apply to mobile phone contracts where a handset is supplied free. The entity must look at standalone price of such handset and some of the consideration for the contract should be allocated to the handset. Let's do an example. So mobile phone gives customers a free handset. Okay, when they sign a 2-year contract for provision of net. So when you take my network services, I'll give you a phone fee. Okay, the handset has a standalone price of 100 and the contract is for $20 per month. Okay, so how you should do? Handset is 100, contract value is 480. Correct? How did you get 480? $20 into 24 months. Right? See, this is a 2-year contract. So the total standalone value of goods and services is 5. They found what is the percentage of each upon the total standalone price. So 17% is to the price of the handset and 83% is to the price of the net. Now, we are supplying the handset free, right? We are only taking 480 from the customer. That 480 is divided in this proportion, and now we found the transaction price for handset and the con. Now you have to understand that this handset is satisfied at a point. That means once I get the handset, I'm satisfied. The control passes over to the customer, so I'll record all 80 in year one. It's this the remaining, that is 480 into 83%. What is 480 into 83%? Okay, 480 into 83%, 398.4. After the end of year, only first, it's a contract for 2 years. So hence we have to divide, since it is over a period of time, we have to divide it by 2. That is why they have 99 in year one and 199 in year one and 199 in year. Okay, they are not recognizing the whole 480 into 83% in one. Right? Is that clear? How to allocate transaction price to performance obligation? Yes. Okay. Now let's take a 10 minutes break here and we will resume after the break. Okay. So we'll resume and we will do this recognized revenue and performance obligation as such. We'll do the last, fifth condition. Okay. We'll take a small break.